Good evening. Today is Black Monday, the day the Dow dropped more than 500 points. The day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929. But this crash of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver without a parachute. The panic starting in Tokyo this morning while the West slept. One cause of the sell-off was reaction to last week's 236-point drop in the Dow. The result, the Nikkei average was down 260 yen. Then, like a plague, sell fever headed west. In Frankfurt, fears of higher interest rates in the U.S. triggered the drop there. In 2.5 hours of trading, the Commerzbank share index fell 132 points. In London, an even larger drop. The British market, trying to cope with Friday's national computer failure, was thrown into a near panic. The result, the London Financial Times index down more than 183, the biggest one-day drop in Britain's history. And from there to Wall Street, where the numbers speak for themselves. Unofficially, the Dow stands at 1738.41, a drop of more than 508 points, with a volume of more than 604 million shares. Proof, as Alec Roberts reports, that the panic hit a fevered pitch.
From the opening bell, the market was in free fall. After last Friday's record 108-point loss, analysts had expected a rally. Instead,
it's panic. Everyone's in panic. Everybody, we're trying to find a bottom. And we're trying to, as a floor broker, I see stocks trading 10 points below where they traded Thursday, and I'm saying this has to be the bottom. And then they trade 5 points lower than that.
By noon, the market was down about 150 points. The tape delayed by more than an hour. But it only got worse as trading brokers struggled to cope with a blizzard of sell orders.
To Mexico, we have some work here to do.
Since the market hit a high of 2,722 last August, it lost 17.5% of its value to 2246 by Friday, and another 508 points today.
More and more analysts believe that the bear market is here to stay. It's not that the economic news is so much worse. In fact, some indicators are showing unexpected strength. It's the psychology that's changed. While for 5 years investors have looked at the economy as a glass that is half full, now they're seeing it as half empty.
Reasons for the decline have been floating around for months. An accident waiting to happen, according to one analyst. Renewed inflation fears with a decline in the dollar, rising interest rates, and huge budget and foreign trade deficits. A nation living for too long beyond its means.
All right. Today's Monday, the 3rd of March. This is a recap for the stock market activities today. And folks, I got a good one for you today. I hope you enjoyed the intro of the video. Going back in time to 1987, the good days. That was the OG Volmageddon. We did not have the circuit breakers as we've done in 2018. And of course, 1987 was before the invention of the plunge protection team. So things just played out the way they played out. If the market crashes 20% in a day, so be it. Now, of course, we have the plunge protection team, but maybe with all of the Doge firings, as somebody said on Discord today, they're going to fire the plunge protection team, but we see a big Volmageddon, shall we say, 3.0. Now, you might have noticed in the video that they talked about some things that we've been talking about in this channel for a long time. For example, when they said, hey, the change in the market happened because of a change in psychology. This is something I've been trying to float out for years now in this channel. A lot of folks don't understand how psychology plays in the stock market and the economy. This has been the subject of my research, and I published a lot of stuff about it throughout the years, and it's seldom talked about it. Folks usually want to talk about the macro data or the corporate earnings or whatever innovation that we have going on at the time, be it AI, be it the radio, be it the internet. But then when something like 87 happens, everybody's baffled. What took place? Why did we see such a flush and change? What caused a market crash? Historically, what causes market crash, it ain't really a change in the economics. The change in the economics happens later, after the market crash. It's usually influenced by the market crash. Now, what was the origin behind the market crash? It was a change in psychology. It was a distribution pattern. The dummies chased, the holders, the oligarchy, the big shots, the whales cashed out because their psychology changed. Their perspective about what's going to happen to the economy changed. Keep that in mind. In the video, they also talked about the glass half full, the glass half empty, all of these analogies we've talked about before, about the Trump presidency and the stock market and AI and all of that. They also talked about inflation being stubborn and rates being higher. So the similarities are amazing. The ingredients are all here, and they've been here. They're just waiting for the spark. Maybe the Trump presidency and the decisions that we've seen recently would be the spark. Now, if we look at the crash that we got in 1987 in the Dow Jones, sure, it was a steep drop, and it came on the heels of massive gains that preceded it. And the psychology is really important because while everything was going higher in a crazy way, nobody really questioned why. Oh, it is justified because fill in the blank, AI, whatever bullshit at the time they want to plug in. The Reagan administration, whatever policy they want to float, doesn't matter. The end of the Soviet Union, doesn't matter. Whatever excuse to justify and explain the unexplainable that we know is dumb. Then comes the resolution, the unwinding of such stupidity, and it is just a mere transfer of wealth. So the folks who chased, at that time it was a lot of retail traders, a lot of retail investors, a lot of mom and pops, chasing the move higher. Then the whales, the insiders, did the sell orders. Thank you so much. The wealth is now transferred. Goodbye. And all in all, if you have a trend line, the surge that we've seen in 87 and the crash, if you erase that, nothing happened to the market. It was still within a trend line that continued to go higher. But you always have to remember, the higher the mania, the sharper the crash. And this is the example of 87. We had a huge mania post-elections, combined with the AI mania and the rate cuts mania and the soft landing mania. And things got exaggerated. You might see such reaction right now that takes the fluff out. With that setup out of the way, let's dive right into it here, folks. In Focus tonight. Volmageddon, baby. Because the traders are making a big bet here on an explosion in the VIX, the volatility index. The headline reads, option traders are bracing for a stock market crash. Uh-oh. What are they talking about? Here it is. Traders appear to monetize, that is, take profits from put options tied to the S&P 500, as the index's last struggles pushed many of those contracts into the money. That caused the skew, quote-unquote, for S&P 500 put contracts, which measures demand for further out-of-the-money contracts against those are closer to paying off, to ease somewhat. In plain English, why did we see the rebound on Friday? Because those who bought the put options and they scored big, they closed them. They booked profit, and they're rotating to another trade. And of course, on Friday, the market maker receives this message. Says, okay, folks, you're closing your puts, you're cashing out, and maybe you're switching to calls or other bets. So I'm going to exercise maximum pain on the Johnny-come-latelys who bought the puts recently, who are chasing the action, and close the tape higher. That's what it really means. Now, the most important point is, for those traders who are betting on S&P 500 put options, and they cashed out Friday, where did they rotate? Here it is. But at the same time, demand spiked for deep out-of-the-money VIX calls, bullish contracts tied to the VIX that would pay off if the gauge soars above 50, signaling that there is plenty of demand for crash protection. In fact, Thursday was the second highest volume day on record for buying off high strikes, 50-plus VIX calls, with a customer buying over, listen to this, 260,000 contracts of the May 55 and 75 strike calls for a total cost of $10.7 million. We covered this unusual trade the moment it came out on the daily show right here. Indeed, the CBOE data showed net customer buying of deeply out-of-the-money VIX calls soared nearly 250,000 contracts, the largest one-day reading since May 4th of 2023. In other words, the traders are betting on a Volmageddon kind of phenomenon now. And they think that the S&P 500 put options are more expensive, less rewarding than buying deep out-of-the-money VIX calls. That's what they're doing. And it becomes a self-fulfilling prophecy that we see an explosion in the VIX. They're betting on a Volmageddon phenomenon, a climactic move. And that's the kind of ingredient that you need to get phenomenons like Volmageddon in 2018 and the OG Volmageddon in 1987. We have signs here supporting such action to come really soon. Among them, the most important sign is the biggest stock that led the AI mania that all bets were on that's going to save the economy from any weakening in the consumer and all of that. When you see the stock, which is NVIDIA, dropping down by more than 9% today alone, and it's down over 20% from the top, NVIDIA wiping out 6 months of gains as the AI trade unravels. That's a warning sign that fear is increasing, and as fear increases, you're gonna have that climactic move coming really soon. Of course, they attribute the drop in the market today because of the tariff announcement. Dow tumbled 650 points as Trump confirms tariffs on Mexico and Canada will start Tuesday. Well, we already knew about that. We already knew that the tariffs are going to start, at least the viewers of this channel. We knew that when they delayed the tariffs for 1 month, it was a negotiation tactic to score some goodies from Mexico and Canada. But the tariffs are here to stay. The tariffs are part of the economic dogma of the Trump administration. They're not going to go away. And it's stupid for the market and traders, investors, and asset managers to dismiss the reality of the tariffs and the change in policy. But they're now succumbing to the reality that it's inescapable. And when we talk about these massive tariffs against all of these countries, that's going to have a huge economic impact from a stagflationary perspective, increasing the cost on the consumer and reducing the pace of economic growth. Of course, you have, these perma pumpers are just notorious. It's unbelievable. A veteran trader says why tariffs are not the problem in the stock market. Or really, the truth is, if you look at these tariffs right here, Mexico 25% on all goods, that's coming out tomorrow. Well, that's a huge deal. We import a lot of stuff from Mexico, food, and that's going to have a huge impact on the CPI. You have Canada, 17% tariff rate. Now it becomes 25% tariff rate on all goods and 10% on energy goods. China, we have an additional 10%, so now we have a 20% tariff against all goods from China. We have more tariffs coming out on aluminum and steel, on the agricultural products, on cars, on chips, on big pharma, on copper, and the European Union tariffs coming out. If the president doesn't back off, we will see guaranteed 1,000,000%. We will see this volume-getting phenomenon. And we're running out of time, folks. Because this stagflation bomb, it is the worst outcome for the market because it handicaps the Fed. We talked about that numerous times in the program. The fear from the tariffs is the stagflation because tariffs will increase the cost for the consumer and then reduce the pace of growth. We already see that happening, folks. We got data today that supports the idea that stagflation is storming the economy right now. The manufacturing ISM. So you look at the headline reading down 0.6 of a point. New orders down 6.5 points. Employment down 2.7 points. While prices up 7.5 points. Unbelievable. You can see for yourself right here. The price paid index, or the manufacturing PMI, is the highest since mid-2022. That is called reinflation, baby. You combine that with the weakness that we talk about all the time in the program, the consumer, new orders, and you see it in the index itself. You see that employment is down. You see new orders down. The combination of both is stagflation, aka the worst outcome. And this is why, folks, in this program, in this channel right here, we gave you the stagflation portfolio. And so far, so good. The majority of these names been holding. Part of the stagflation portfolio is not just the long portfolio, it's also the short portfolio. What do we short? And the answer is what has been working. The stuff that went crazy betting on, the Trump administration is going to do this, the stuff that's going to get hurt from the trade war and the industrials and technology. The mentality is really important right now, folks. And you cannot hesitate. You know where we're heading to. We're heading towards stagflation. Position your long portfolio to have at least some of these names. And position your short portfolio to be brave, to take shots on stuff that doesn't make sense anymore. All of this was talked about in details in the program, and I feel really sorry for anybody who too stubborn to say, hey, Mav, I'm not going to pay for your subscription, the $5, $10, even the Discord, the $25. But think about it as an investment. You can do it as a tax deductible if you'd like. Take it out of your business costs, your trading taxes. But I feel sorry for you if you're missing on these conversations right here. Because when the markets get really tough, all of the big shots on YouTube and social media, they're baffled, they're dazed and confused. They have never dealt with such markets. They've dealt with the easy markets, which even a blindfolded monkey can outperform them in. But when the markets get tough, you need the experience, you need the discipline, and you're getting it right here for a penny on the dollar. Just keep that in mind. And we've added some of these names in the portfolio recently. So we added Dollar Tree and Meccasin. Dollar Tree is not doing pretty good, at least today, but we have earnings coming out soon. We'll see what happens. Also, sometimes we'll get into an idea like Emerson, which looked pretty good a few weeks ago, not so hot. So we sold that recently. It was a good call because the name flushed down today. We sold Nintendo for a gain. So we're doing portfolio moves, not just options, folks. You'll see that in the portfolio channel in Discord. But we go back here to the impact of the tariffs. Today, we've seen Moody's chief analyst or economist coming out saying that the tariffs by the Trump administration will cost American households at least $1,250 a year because of these tariffs. But that's an added cost on the consumer who's already getting brutalized in the economy. This is how you hinder the rate of economic growth, and this is how you ensure that the inflation rate is going to stay strong. That's the worst of both worlds, really. And until we have a solution, it's going to get ugly, folks. Because when the Fed cuts rates, for example, let's say we get a bad jobs data Friday and the Fed cuts rates. Now you're amplifying the inflation problem. If you decide to hike rates to mitigate the tariff problem, which is increasing inflation, you're going to hammer the economy. You're going to cause it to dip down into a massive recession. So we get stuck here with the Fed having nothing to do, can't do anything really. And the market says, okay, at least the holders who are sitting on profits, they say, okay, we don't have the Fed put anymore. We don't have the AI put anymore because NVIDIA is going down. And we have all of this chaos and uncertainty. And folks, please understand that what I'm saying right now isn't reflective of my personal point of views of what the administration is doing, whether it's right or wrong. We can agree that we need tariffs, for example, that we need fairer trade policies, that we need to reduce the reliance on income taxes and increase the reliance on tariffs. Got it. I agree with some of that, but I'm just being honest with you here about what the economic impact will be. There's a price to pay, and that price might be a recession and a stock market crash. Furthermore, adding to the uncertainty, we got the breaking news after the bell that Trump is now pausing all military aid to Ukraine. After the Ukrainian weasel came out to the White House and couldn't really even do the simplest job of them all. When you're begging, you kiss ass. You say, please, you're the best. We've never had such support from you, Mr. President. But he acted all entitled, and now look at the ramifications that he's getting himself to. And his country, by the way. But this is adding to the uncertainty. What are we going to see here? Are we going to see a flare-up in the war? Is Russia going to take over more territory? What's going to happen to wheat? What's going to happen to nat gas, to fertilizers, to soybeans, to all of the commodities that come out of that region? Now, is there a silver lining? Yes, there is. But this is really important for you to pay attention to because we've seen the phenomenon of Fridays being really ugly along with Mondays. And then we see Tuesday, Wednesday, Thursday doing pretty good in the stock market. So you see the weekend gap here is the largest in history, at least in this century so far. We see a huge gap between Fridays and Mondays. And what is the message by the traders here? If Mondays, Fridays, we see downside action, then we see a rebound Wednesday being the biggest rebound, as you can see right here. We talked about this before in this channel, folks. Those of us who traded in the Trump 1.0 administration, we knew that Fridays become buy the VIX Fridays because you never know what's going to happen over the weekend. Mondays, of course, reflective of that. Then he comes out with a tweet Wednesday and he says the stock market better than ever before. We're going to support this, do that. Saudi Arabia is going to invest $16 trillion in the country tomorrow. And he pumps it higher. So that's the kind of pattern. So I would say that if we don't get any resolution by Wednesday, oh boy, this is going to get really, really ugly. And we will have the volume kind of phenomenon. So if you're a trader, and I did the chat session today, a lot of folks say, Mav, I missed on the move. I don't know, the puts are kind of expensive here. Do I wait for a rebound? Do I play a rebound? You got to look at the charts from a longer dated perspective and make your decisions accordingly. So we'll do the charts analysis in a minute. But here, if you're betting on a rebound, the statistics say Wednesday's your best bet. So if we have another sharp decline tomorrow, then maybe you should have some protection for a rebound Wednesday. But if Wednesday comes to pass and there is no rebound and the administration is not backing off the tariff, then something will snap. So folks, be brave, be disciplined, and look at longer dated charts and make decisions. There are no invitation cards here. You got to make your own decisions. And with that, folks, let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices. And here we go. The diamonds, deep in the red, down by 649.67 points, or a loss of 1.48%. That's, of course, you have a lot of the insurance names, you have a lot of financials, a lot of technology, a lot of industrials. So we see the Dow succumbing to its wounds here. Even though the Dow has some pharmaceutical companies, but the weight is not enough to keep it afloat. Majority of the damage happens in the NASDAQ as the big guys go down. I mean, NVIDIA down 9%. That's a huge deal. Down 497.09 points, or a loss of 2.64%. And the S&P 500 between the Dow and the NASDAQ in the red by 104.78 points, or a loss of 1.76%. The leading indicator, Russell 2000, says no relief in sight, down 5.87 points or a loss of 2.73%. Looking at the sectors, the outperformer being defensives and real estate. These are the stagflation themes, although I'm not a believer in real estate. I'd avoid that, rely on consumer defensives instead. Healthcare did pretty good, but it shows negative here because a lot of the biotech names and the risk-on names were down. We'll explain a little more. When we talk about the heat map analysis, you don't want to skip that. Those of you who skip the heat map analysis, you're missing out on a huge and critical part of the conversation every night. The same thing happens in utilities. It's supposed to be positive, but again, the risk-on segment is negative, so we see the entirety of the sector being dragged in the red. The laggards, recession theme, technology, energy, cyclicals, industrials, metals, at the bottom of the pack. Looking at the breadth, it is ugly today. In the NYSE, 21% advancing, 78% declining. The NASDAQ, 16% advancing, 83% declining. So, excessive? Yes. Usually, do we see a rebound? Yes. But we also have circumstances when the breadth gets really, really bad. And we see folks stampeding on zero DTE puts. And we see folks stampeding on buying VIX calls. And we have the right circumstances from the administration and the news and the macro. The breadth can get even uglier. Keep that in mind. On to the heat map. We begin with, what do we see here? What is the main theme? The main theme is the stagflation theme once again. Stagflation portfolio wins. You see it all over the place. In financials, anything that is risk on, like the asset managers, the Goldman Sachs, the Stanleys, the big banks, the regional banks, those are all down. But you look at the risk off within financials, which is part of the stagflation theme, or stagflation portfolio, the insurers. Those are doing pretty good. Progressive, Schwab, all of them. Aflac, doing pretty good. Likewise, when we look at the healthcare sector of the stock market, what is the risk on? Risk on is biotech. Risk on could be considered as the insurers. Some of the diagnostics and the stuff that requires spending, capital spending, and the stuff that went in extreme valuations like ISRG. That is considered as risk on, and it goes down when we have a recession/stagflation theme. What thrives, though? The big pharmaceutical names with a lot of dividends, so Sanofi, Amgen, Gilead, Bristol Myers, Merck, AbbVie, J&J is a master in this kind of environment. I'd avoid Eli Lilly and NVO, though. And then we see cheap valuations in some of the medical devices, like Abbott been cheap, and now it's appreciated a lot since the latest earnings report. Stryker is promising. Medtronic is a name that I own in the portfolio and suggested you buy the dip after the report caused a big drop because it has the tendencies of going down but then closing the gaps, and now it closed the gap and then some. Looking at the industrials, again, we see anything that is cyclical, anything that is risk on getting absolutely smashed today. Anything that has any relationship with the data centers getting killed. The airliners getting killed, the United Rentals of the world getting killed, all of the electricity plays like VRT and Hub, all parts of the data center plays you see in utilities here. We'll talk about that in a minute. But what is the risk off within industrials? What is the safety? The stagflation/recession theme within industrials. It is the classic defense contractors, Raytheon, Lockheed, Northrop, GD, but I will avoid that. I'll stick to Raytheon for now. And bear in mind that the European defense contractors are doing a lot better now that we've cut all of the aids to Ukraine. So they're going to have to spend more money on BAE systems. A lot of the European weapons manufacturers, those are worthy of adding in your portfolio if you have access to them. If you don't, if you just have access to the U.S. manufacturers, then you probably want to do Raytheon. Among the risk-off segment within industrials is waste, garbage. Waste management, Republic Services all pay great dividend, and they hold pretty good during a recession and stagflation. Onto utilities, same thing. You see the southern part, which is the risk-on, not doing pretty good. The classic utilities, which is the risk-off, doing pretty good. You look at metals. A lot of them are risk-on, with the exception of some of the gold miners, but again, gold is way too hot right now. So we see, again, in the recession theme, metals, the beauty of metals. Within a stagflation theme, it shows you which risk is more dominant, inflation or recession. So if you see, for example, the same map that we see right here, but we see metals and copper going higher, then that's suggesting that the inflation risk is still dominant, still strong. You cannot ignore it. But when you see the metals going down along with the risk-on segments, then you know that the fear right now within the stagflation theme, the most dominant fear is a recession fear. And energy, by the way, does the same thing. When energy is down, so we've seen stagflation themes in the last couple of weeks, but on days we've seen ExxonMobil up, we've seen the energy names going up. That tells you that the market is treating it as stagflation theme. as both risks are worthy of considering. Yet when we see the metals going down and we see energy going down like this, the market's message is, nope, I'm thinking that the recession fear is more dominant right now. The best hedge against stagflation or a recession is the staples, and we see them appreciating as we expected. The names like Kraft Heinz, Hormel, Conagra, McCormick, which we added recently to the portfolio, GIS, General Mills, Campbell, the tobacco names, Philip Morris, anything that has to do with alcohol, specifically the beer at home. So Budweiser was pretty good, it exploded higher. Tap, Coors, that's going to be the next one. And then you see the chocolate, Mondelez, Hershey's doing fantastic as of late. PepsiCo, Coke, Procter & Gamble, all of the classic names doing extremely good. The only notable downside that we see today is Kroger. Kroger had some earnings, but also the CEO got ousted. That was sudden for creepy behavior, perhaps. And I told you that this creep is the only thing that I don't like about Kroger. I think I talked about that a couple of years ago, that Kroger is my largest holding in my portfolio. The only thing that I don't like about the company is the CEO. So I'm not surprised that he's gone, but of course that's going to cause a negative reaction in Kroger today. The stores, you got to be careful with Walmart, Costco. Costco has earnings coming out. We'll see how that's going to play out. But Target is weak. And the dollar stores might be the only hope left here if you're going to bet on any discount stores. Cyclicals down across the board in a stagflation/recession theme, but we have some exceptions. Airbnb moved higher today. And then we have Las Vegas Sands here. And I think a lot of folks are speculating about the weakness in Vegas. We'll talk about that in maybe an upcoming video. But they talk about the weakness in Vegas as a leading indicator to the economy, and that's accurate. But I will tell you, because I was at the Wynn and the Bellagio and all of that over the weekend, and it'll let you know that the luxury properties, the affluent consumer, Vegas is still hot. Vegas is not hot for the middle class, for the regular consumer. So you see the luxury properties like Wynn and Las Vegas Sands doing okay for now. Maybe not so hot so for MGM, though. Then we look at the cyclicals here, Amazon down, Chinese names not done going down, I think, and all of the automobiles are down, led by Tesla. Telecoms here, the classic stagflation theme holding pretty good, AT&T, Verizon, T-Mobile, but anything that is risk on, like Netflix, Meta, Google, Spotify, all of these names getting hammered. In technology, once again, you see that anything risk on, NVIDIA, Microsoft, the big guys getting hit, risk on within chips getting hit, even the risk off, like Intel, the value also got hit. And you see also the software that's risk on. So software is immune from tariffs, and it's still an attractive sector of the market regrowth. It provides growth with efficiency and no tariff exposure. But when you have days of oversold, or let's say the VIX goes higher, where we see the algos selling everything, software will be considered as a risk on, or you see it selling with everything else. Now, if we see cooling off the sentiment, the fears, then we'll talk about the dip buying opportunities in software, because keep in mind that you see, for example, Okta, after the bell, Okta was down about 4% today, but it's up 15% after reporting earnings. So that's going to solidify to investors at some point that not everything is ugly here. If we don't have a recession happening right now, then you probably see some dip buying opportunities in the tariff immune software and cybersecurity soon. Looking at the heat map for the ETFs, what do we see here? No major movement in the TLT, so we know the bond yields were stable. There's nothing major that happened, but it is still a risk on or risk off kind of theme, because the TLT went a tick higher, and we see the sell-off in the risk assets like the IWM, KRE, XBI Biotech, XRT Retail, Home Builders, anything that is risk on get absolutely clobbered today. What didn't get clobbered is the risk off yield sensitive, XLU, XLP, IYR, XLV. And again, folks, when we talk about yield sensitive in a recession mentality, we're not talking about yields going higher anymore. We're talking about yields going down. So yield sensitive risk on means when yields go down in the recession theme, you see these risk on stuff going down. You see the risk off stuff like the XLP, XLU, IYR, and XLV doing pretty good. So keep that in mind, because a lot of folks don't understand when we talk about yield sensitivity. A lot of folks don't understand what that means. They think that when yields go higher, IWM goes down. But no, which fear is dominant right now? Is it the recession fear or is it the inflation fear? If it is the inflation fear, then yes, when bond yields go higher, IWM will flush down and all of the risk assets will flush down. But when we have recession fears dominant, then what's going to happen? Every time bond yields go down, risk assets go down too. Nothing was spared here, folks. Even the RSP, the equal weight, dividends, value, mid-cap, it was an inclusive sell-off across the board. There were pockets of safety, though. International markets did okay because the dollar went down, so Japan did okay, Europe did okay. We'll see how Europe is going to behave as we get the tariff news overnight. But we see with the dollar coming back down, you see silver, we see gold, although the gold miners lagging, and we talked about that before. You stick with the commodity, not the gold miners right now. Natural gas remains a hot theme, so nat gas is up, UNG, not reflecting in the XOP though. So maybe right now, if you're betting on bullishness in nat gas, you stick to the commodity, not the stack level, at least for now. On to commodities. Interesting action today in energy. It is reflective of recession theme once again. Of course, folks floated the news that maybe Saudi Arabia or Russia will increase the supply. We've heard these news before. Oil went down initially, then went higher again. This is the participation by crude oil it is the stagflation theme, but it is specifically the recession fear within stagflation. So we see WTI down about 2.25 points, Brent down about 2 points, gasoline RBOB down about 2.5%, diesel down about 3%, but we see nat gas part of the new three amigos. Nat gas has a strong tailwind from the weather and Ukraine and all of that. The supplies in Europe are down. The supplies in Asia are down. Somebody has to replenish that. Without a resolution with Russia, then supplies have to be refilled using US LNG. And this is why we see nat gas moving up higher by 7.5% today. Looking at metals, with the dollar going down, we see a good picture for metals here, although the gains are muted for gold, silver, because again, at least in the case of gold, it is overbought. So if you think that the dollar is going to continue to decline, you're better off going with silver over gold, at least in the, let's say, next few days. Copper also rebounding, but copper is sensitive to recession fears. It's up only today because of an algorithmic / mechanical reason when the dollar goes down. But I would not trust copper right here. I'll show you the chart in a minute. If we have more recession fears and we have bad jobs data on Friday, copper will suffer. We begin to see palladium and platinum outperforming, and keep an eye on palladium. If it begins to outperform, then we're seeing folks using palladium as a hedge now. So palladium led the day with gains of north of 4.5%. Looking at the grains, even though the dollar is down, grains are down altogether because we have now, folks were anticipating the tariffs for the agricultural products. And therefore we see soybeans, wheat, corn, oat, all of them down across the board. When we look at the softs, the old three amigos not doing so hot, so cocoa down about 10%, good for Hershey's, good for Mondelez. OJ down about 4%, good for PepsiCo. But coffee, part of the old three amigos, but still strong. Up more than 2.5%. By the way, Smucker, when they did their earnings, they're actually raising the prices of their coffee and making money from the increase of the price of coffee. So that's an interesting finding. But the classic names would be Starbucks. That's the one that's really tracking coffee futures. Corn futures muted sugar, which is supposed to be part of the new three amigos, down 1.25% today. But keep an eye on lumber, because it is neck to neck here. Who's going to be the third member of the three amigos? Sugar or lumber? Lumber is up about 2% today. Listen to this. U.S. import taxes of more than 50% may ravage Canadian lumber. So you can pause and read the article for yourself here. But when you add all of the cumulative tariffs against Canadian lumber, it will add to over 50%. Well, what is that going to do to the price of lumber here? It's going to increase it higher. That's going to impact the home builders, the Home Depots, the Lowe's of the world negatively. Keep that in mind. Moving on to the options market, aka the big casino. What do we see here? The volume, believe it or not, was shy today. It was concentrated on Nvidia and Tesla, and the volume of calls was still above the volume of puts by a lot. Translation: the decline that came midday after the announcement of the tariff caught the traders by surprise, and this is why we've seen a last-minute stampede on 0 DTE put options and tomorrow's put options, and that caused the market maker to squeeze to the downside, an inverse gamma squeeze. And this is why we've seen exaggerated moves to the downside. In Nvidia, down 9%, that's huge. We're shaving off about $300 billion over the valuation of Nvidia casually. Now, the good news for those who are anticipating more downside to come, the fact that the calls overwhelming the puts again says that we're still in the early stage of a flush down. Once you see the puts in the high 50s, 60s versus the calls, okay, now we're getting to the end of it. Likewise, the IV ranks are 50s, 40s across the board. We see 60s here and there, which means we have plenty of room to increase the implied volatility to the downside if the market chooses to go down, if the VIX chooses to explode higher. Once we see the puts overwhelming the calls, high 40s, 50s, we see the IV ranks closer to 80s, 90s, you know that the flush is coming to an end. Moving on to the unusual activities, beginning with the bullish ones. What do we have here? We have IBB. This is the NASDAQ Biotechnology ETF. Somebody's making a bullish bet here. We know that biotech is not good under stagflation or recession. It's a risk-on sector. So somebody's doing a bet here, but they're being cautious. This is the way to do it, by the way, if you're not sure. If you're speculating on the bottom, this is the best way to do it. In this case, they sold the 127 puts and they bought the 122 puts. The expiration date is June 20, 2025, netting a credit of over $3 million. Why is this the best way to do it? Number one, when we see the IBB, for example, flushing down, are the price of the calls or the puts will appreciate the most? The answer is the puts. So if you're betting on a rebound and you're not sure, you don't know if this is a falling knife, if we got the bottom or not, if you buy just naked calls, sure, you might get them at a better price, but what if the rebound doesn't happen? And we have more flushing down. Then in that case, then the bet goes kaput. But if you have a bull put spread as they're doing right here, you have a credit of $3 million. And if the IBB heads down, let's say right now it's trading at 136, 135. If it goes down closer to 127 or below 127, you still got room for maneuver. You still can have the decay on your side as time goes by. You also still have the possibility, because you got $3 million in credit, to close the contract and take a smaller loss. Next, we have ADI, analog devices. So the chips are not doing so good, but this is a value name within chips, and somebody's betting on a positive outcome. They bought the 240 calls for the expiration date April 17, 2025, spending about $2.25 million. It goes hand in hand with this guy right here, AMD. Is it a valued chip? No, it's overvalued, but we have a lot of hype among the retail traders about it, that maybe it is an opportunity, but if NVIDIA goes down, I don't expect AMD to replace it, because AMD has a worse business model. Regardless, somebody here bought the 105 calls for the expiration date March 21st, 2025, spending about $1 million. And then we have MDT, Medtronic, one of my favorite. Somebody sees more gains to come. They bought the 100 calls for the expiration date May 16, 2025, spending over $600,000. The name is trading at about 95 right now, so not so far. And the rebound after the gap down post-earnings is just a beautiful sight to see. Do yourself a favor and look at that chart. It goes hand in hand with the bet for the ticker ABBV, AbbVie. I'd rather bet bullish on the big pharma and the healthcare names, not the chip names like AMD and Analog. But anyways, to each his own. In this case, they bought the 230 calls for the expiration date June 20, 2025, spending north of $1.5 million. And here comes J&J. The best name is stagflation, best name in a recession. They bought the 175 calls for the expiration date May 16, 2025, paying about $1 million. Right now, J&J is trading at about 166, 167. On to the bearish trades, all of them for the indices today. So we begin with the Qs. Somebody bought the 400 puts. Mind you, we're trading at 500 right now, so this is extremely bearish. This is betting on a crash. They bought the 400 puts May 16, 2025, spending about $2.5 million. And then we have another one here against the SPY. A little bit more reasonable though. They bought the 558 puts for the expiration date April 17, 2025. SPY right now trading at about 583. And they spent about a little over $5.5 million. They're not going to spare the IWM, of course. They bought the 201 and the 199 puts for the expiration date April 17, 2025, spending about a little over $1 million. You add all of these activities of betting against the indices and the stuff that we've seen in betting for out of the money VIX calls, the traders all in all have a consensus, at least the big traders. We have a climactic move coming. Let's do the chart. So we begin with the VIX 2 hours chart. This is the most important chart because it is leading the big caps and the movement in the indices. And as we can see here, we have demand and volatility. We talked about the 2 hours chart in yesterday's video, that we could be seeing here a movement higher. And so long as we trade above 20, sure, we closed below 20 on Friday, but that could have been a product of options expiration. And what happens right now is we see resumption of demand on hedging. And what could be at this point is perhaps a series of higher lows, higher highs. So a lot of folks would look at the closing candle in the 2 hours and assume maybe it is a reversal candle. It ain't going to happen without a reversal in the news that we just talked about in the intro of the video. And so long as we trade above 20, any pullbacks forming another higher low, you get them form another higher high, and the momentum in the 2 hours and the MACD is still positive. And furthermore, when looking at the daily chart, you see that we have, as we said, when you have this sort of a saucer or cup-ish kind of pattern, and you trade above the previous part of the cup, previous high of the cup, usually you see a breakout as we've seen right here. So the VIX right now is on the cusp of exploding higher. There is a climactic move coming in the VIX. And you see here that the RSI is not overbought yet. It can get really, really overbought. And if there is an explosion in the VIX, let's say it goes all the way above 30 or it doubles in a day, then that's going to be an opportunity at that point to begin to short the VIX and bet on a market calm or a rebound. But for now, I don't think we're done yet. I think that the RSI has still got plenty of room to go. The MACD is still in positive territory, and we haven't seen the climactic move yet to indicate that the VIX is done going higher. Combine that with the information that we looked at from the options market in the intro of the video, folks betting on VIX 50 and VIX 60 and 70. There is a big move coming before we get some sort of a calm. Looking at the SPY, the S&P 500, an hourly chart, what do we see here? We talked about the tension pattern. It was broken to the downside. We found support at 585. Then came the fake dead cat rebound on Friday because of options expiration. And the market maker played their games. They wanted the Johnny-come-lately to the puts to lose their money, and they achieved that. They sucked a bunch of calls here, Johnny-come-lately dip buyers, and they flushed them down today. Now, this is the job of the market maker, of course. They have to maximize their gains, but at the end of the day, smarter traders will not fall in the traps of the market maker because they study longer charting trends. So, for example, we have here a lower high, we have lower low. So the assumption is even if you get a rebound tomorrow, you stop short of making a higher high, you're probably heading down to make a lower high. And I think that the next number would be 575. I have it at 576.74, but we can round that down to 575 because it's going to be the mechanical support anyways. Now, I wouldn't say that we're out of the woods in a rebound. Say we get a rebound tomorrow. We're not out of the woods until we trade and close above at least 591. This is a pivotal number right here. We need to rebound, close above, and then we can have a chance at forming a higher high. And again, I don't think that's going to happen without a reversal in the tariff news that we got today. Now, looking at the SPY, the daily chart, some of you love to do the SPY trading. Anything to see here? What we can see is we got a retest of the 50 days moving average today. Didn't work out. And now we formed a bearish engulfing candle. Some will look at this as a stick sandwich kind of candle, which leads to more downside to come. And if we have more downside to come, we're probably going to stop at the 200 days moving average that you see right here in orange. That'll be around 570. And this is why today in Discord, I suggested the trade of the 580, 570 puts, put debit spread, that is. You can do 575, 570. You can do even 585, 575, whichever one you like. But the target right now that we stop and we find some support of 570, absent of an explosion in the VIX. If the VIX goes, let's say, above 50 rapidly, then you can see a huge flush that leads us all the way down here where we can find support at the previous year in September. We can find some support right here at the 540s. That, of course, depends on the explosion in the VIX. And it could even lead us down to the summer bottom of 24. But one step at a time. Right now, we're just anticipating a revisit of the 200 days moving average in the SPY and see what happens. Now, I do like to look at the E-mini futures because these are more of an accurate chart. It's already at the 200 days moving average. The volume, the increase in volume is telling here, folks. And usually when we see that increase in volume, we have more downside to come. So if we go below the 200 days moving average right here, where can we find some support? 5,800 supposed to hold, keyword supposed, because it did before here, it did right here, it did here, it was resistance before. If you can go back in the chart, it was a reliable point of support and resistance. So 5,800 is a pivotal number in this chart, and losing 5,800 will pretty much be a guarantee and a confirmation that we're heading into a bear market. Now, one more thing. A lot of you in the comment section yesterday and last night's video in Discord today said, my 200 days moving average, my 50, doesn't align with the numbers you got right here in your E-mini chart. You have to adjust the chart, okay? So if you have it not adjusted, you'll see the 200 below, which aligns more with the SPY. But if you adjust it and use it adjusted as a leading indicator of what's going to happen in the SPY, you'll see that the 200 will align with my number. So make sure that you have the adjusted chart, because adjusted meaning, by the way, that you're getting rid of the gaps and the changes in contracts. You just combine a continuous contract, which it's the whole point of why we look at the E-mini futures, is when we look at the continuous contract and continuous chart versus the gaps up and down in the SPY or the Qs. Speaking of, here's the Qs, an hourly chart. And where do we see the action? We got the bear flag that we talked about before, headed down, found support at 500, and it looked pretty promising here, folks. It looked as maybe the NASDAQ here is trying to make, even all the way till today, by the way, It was kind of shaping maybe for a cup and handle, the higher we go, but it was a point of no return at the end of the day. We've seen the loss of 500 again. 502 was a leading indicator, the weakness that we see in NVIDIA, and now we stopped at a really, really pivotal number of the chart, which I have it at 493. You see it in red here, and I said that 493 is a red line before. Red line meaning that if we trade above, we're out of the woods, right? We have a bullish trend. We trade below 493, then we have a bearish trend, and that conversation was from last year. So now we're coming back to this number, and that's going to be an important pivotal number for tomorrow. If we lose 493, then probably going to open the floodgates for more declines to come. When we talk about more declines to come, notice the volume here, folks. So the volume, if it was peaking, let me expand this for you so you can see it. If it was peaking, sometimes it actually helps you if you plug in the average. So if you plug in the moving average right here, what you want to see when you have a sell-off and you have the volume increasing, you want to see that the average is beginning to trend down. That is usually an indicator that the sell-off is coming to an end. You need to see the columns, the red columns that you see right here, coming back down. And we haven't seen that yet. I mean, it looks that the column that we got today is lower volume than Thursday, but it's not low enough. It is still higher than a lot of the columns that we got last week. So I don't think that we're through yet in the volume of selling. I think we have a sort of a climactic selling move coming really soon. If that is the case, if we look at the indicators that we got, the RSI is getting closer to being oversold in the RSI. The MACD is also getting a little bit absurd here in the negative momentum. Same can be said about the Vortex indicator. If we expand this, maybe the bearish momentum is coming to a halt here and it comes down and we begin to see a process of reversal. But there's a possibility that you could see the bearish momentum expanding a little more, bullish momentum dropping a little more. Then we see a point where they change and we see the market finding a reliable rebound. But like I said, I think we have one more explosion in the VIX and then we'll talk about that. And of course, the number one support that we're looking at is the 200 days moving average, which is about 492, closer to 493. So if you want to be conservative, you can look at the hourly chart. 493 is my red line, but you can be even more conservative than that. Look at the 200 days moving average, simple moving average, which is sitting right now at 491.97. We can round that up to 492. If you close below that, then there is another climactic move happening. Maybe it pierces all the way below the 200, and then we find support as we've done here in August of 24. And again, we love to look at the NASDAQ futures. We talked about the rising wedge, the flush down after that, the support of 21,000, held for a little bit, broke below. Then you got the 200 days moving average. Now we're breaking below. What's the next stop? 20,000. So, folks, I don't want to sound too harsh here, but it baffles me when I do these long charting analysis and videos with step-by-step explanation, and then I go to Discord or I look at the comments, and I hear folks, do we begin to short now? Do I begin to take a trade right now? I have been saying so from the get-go here, be it in the NASDAQ futures or the E-mini futures. Once we take 21,000, it looks that we're going to revisit the 21,000 because we've already retouched 21,000 multiple times before. Coming back down or retest the 21,000 means we're going to break it. So the trade is the 21,000, 20,000 put spread. You got to take notes, folks. If folks who are skipping the content, you're doing yourself a disservice here because I'm putting all of this effort to give you all the details. And if you skip it, if you're just looking for a 3 minutes, 5 minutes kind of information, rapidly just give me what am I going to trade tomorrow, what am I going to look for, you're just not suitable for this channel here. But if you're taking notes, taking numbers, you'll do a lot better because we looked at the E-mini futures, the same thing. And I said, we visit 5,900, we get closer here after we lose the 50 days moving average. Why would we go down to 5,900 if we've already retested that multiple times before? We're going to go down to break it. And to break it, we have the trade of 5,900, 5,800 debit spread. So you buy the 59, you sell the 58 for the expiration date of March. And that was the trade. It's almost done now. The next trade would be if we lose 5,800. If we close below 5,800, then you have the 5,800, 5,600 trade. But you got to go longer this time around. You got to go for May or April. It might work out if we have the volatility event at that point, but May would be more suitable. Anyhow, we go back to the NASDAQ futures in the daily chart. We have 21,000 already lost. We have the 200 days moving average already lost. What is the next support if we continue to flush down? 20,000. It's supposed to hold, but again, it depends on how bad the VIX will get. If it's just VIX 30, I think that 20,000 will do the job here and offer support. If it is VIX beyond 30, 40s, 50s, we're probably going to breach below 20,000 because we already lost 21,000. And we're probably going to find support in or around the September bottom here. As we looked at the SPY, that's going to be about 19,000. So the next trade is, once we hit 20,000, maybe get a little bit of rebound, fix the oversold conditions. You probably want to go with the 20,000, 19,000 with the NASDAQ futures. The put spread, of course. You buy the 20, you sell the 19. What is happening in the world of the big kahuna Apple? We talked about the resistance at the top of the breakdown candle. Couldn't make it. Apple, of course, is holding stronger than the other big caps due to the manipulation that we see day in and day out. But despite the manipulation, we see Apple losing 242, which is the bear to bull advantage line. We see Apple closing below the 50 days moving average. That's a bearish sign. We see Apple changing the momentum from bullish to bearish in the MACD indicator. Another bearish sign. We see also that we have here in the hour sign negative divergence. Another bearish sign. You add all of the cumulative evidence here. The next stop should be 233. We lose 233. We're heading down to the 200 days moving average, and that's going to lead us all the way down, let's say 225. So the trade right now, the most suitable trade for Apple is the 235, 225 put debit spread. You can go to the 21st. I think that's going to be sufficient, but you can go a little longer if you want to be safer. Other traders will be a little bit on the cautious side, will take the 240 in the money, and they would sell the 220, but they'll go to April, and that's going to give them a wider gap and a higher profitability. So each trader has a style and how they open the gaps and what kind of delta they're going to have and the time. But I would say right now that the 200, 225, if there is a move down in Apple, we should at least find some temporary stability at that point of 225. We have a different story here in the other used to be big kahuna. Now it's below the $3 trillion club. This is NVIDIA. The problem with NVIDIA is below the 50. It's below the 200 days moving average. It's negative momentum already showing up in the MACD, negative momentum in the hour sign, negative momentum in the vortex. And, my outlook yesterday was maybe we have sort of a shoulder head and then we get a rebound of 16 and a half and retest 120 and form the topping head and shoulder pattern. Then we go down. But it appears that NVIDIA is so weak right now, it couldn't even form the shoulder. Maybe already did in this reversal that we got right here on Thursday. It already formed the shoulder line at the higher point, and now we've closed below 16 and a half, which I would consider the neckline. Usually that leads to a decline, so if we take the head all the way to the neckline, an assumption, then take the same move from the neckline, that's going to lead you down below 100. That's going to settle NVIDIA down at about 90. Of course, that move is not going to happen in a day. It could happen in a week or so if there was a huge explosion in the VIX. But I expect this is going to happen in time. I think if there is a climactic move in the VIX, we could see NVIDIA flushing all the way down closer to 100 and then find some support. But in time, it reaches 90 because we have support right here. And this is going to be retested. 90.69 will be retested. Mark my words. But here's the thing. I gave you a trade on Discord. The 100 NVIDIA calendar puts. So that's what we're going to do for now, but the chart doesn't look very good, folks. Furthermore, clean up the chart right here. And we don't need the moving indicators or moving averages at this point. What I want to show you is if we just grab a trend line here, we have a trend line. It doesn't have to be with perfection, right? But you can see the trend line, and we've revisited support before. 1, 2, 3, 4, 5. It always bounced. It's been reliable. We've broken below after the deep seek. Retested the same trend line and we went down. Now we're forming a lower low of the initial deep seek drop. So that's a huge bearish behavior by the chart that it gave up on the bullish trend. And it's giving you a leading indicator that, hey, NVIDIA about to head into a bear market. And if NVIDIA head into a bear market, the stock market all in all is also going to be dragged down into a bear market. Lastly, on NVIDIA, I look at the weekly chart, and yesterday we explained the importance of the 50 weeks moving average. So right now we're below. If we close the week below, it's further confirmation that the top is already in NVIDIA, and it's time to short it, not just via options. It's time to short the stock because it's going to come down and settle at this range right here, the 40, 45, 50s. And that's going to be a juicy drop. Stock is going to lose over 50% of its value. It's not going to happen right away. There is a report coming either next quarter or the quarter after, where we see NVIDIA finally showing a massive slowdown in the rate of growth. And that's going to be what does it. And then we'll see what happens, one step at a time. But right now, losing the 50 weeks, it adds to the evidence that NVIDIA is so weak. The second indicator that we got is the 10-year yield. And again, a flush down in bond yields when we have recession fears, not going to bode pretty good for the stock market. It's now below the 200 days moving average. I do think that yields are going to rebound, but I'm thinking about a catalyst. Could it be the fake jobs number on Friday? They're going to cook that as a rescue? Maybe it could be. Maybe the ADP report, who knows? But there is a catalyst that would lead to a rebound in bond yields. I don't think that's going to happen, though, without the climactic move in the VIX first. So the VIX explodes, big flush down in the indices, maybe a big flush down in bond yields, and then we begin to see, if things begin to get really, really absurd in the oversold conditions that you see here in the RSI and bond yields, or the S&P index level, or the NASDAQ at the index level, or NVIDIA getting really oversold in the daily chart, then you're going to put two and two together and say, okay, now the premiums are way too high, the puts ratio in the 60s versus the calls, things are getting really excessive, time to book profits from the puts and switch to the calls, or switch to a rebound play. And by the way, a rebound play in the market will happen when a rebound play in bond yields, because when we have a recession mentality, when yields move higher, that's good for the market because it's alleviating the recession fear. But so long as bond yields continue to crack, that's exacerbating the recession fear. And that's not good for the equities market. Now, of course, a lot of folks would say, should I buy the TLT at this point? Maybe. But again, I told you this is not going to be an easy ride, because you're now the 200 days moving average in a retest. And last time we've done that, we failed. Right now, we have the recession fears dominant. I'm not saying that the TLT cannot go higher. It can. But it's going to be challenging, because sooner than later, you're going to hear a tariff negotiation, for example, and you might see the bond yields rebounding higher again, recession fears alleviated, TLT comes down, and then we have, again, recession fears coming back up, and then we see inflation fears dominating again, and we see TLT heading down. So it's going to be a jittery ride here, but so long as we have a movement in the VIX that suggests that we're not done, and we have all of this fear about a recession, then yes, the TLT at least makes a good temporary hedge against your exposure. The Russell 2000 daily chart, what do we do here? This is what we talked about in last night's video. Whatever rebound you get, it's going to flush down. Now we have a bearish engulfing candle. The IWM has been always the leading indicator. And if it continues to go down, let's say there's a climactic move in the VIX, where do we stop? RTY 2000. I'm going to spit the trade for you again, because we talked about this before the break happened. 2100, and then you sell the 2000. 2100, 2000, put spread. March 21st, we'll do the job. You can go a little longer if you want to be conservative. But don't wait till things already happen and the VIX is already above 30 and the indices here are all oversold, extremely oversold, and then you want to enter something. Too late. The good news is you're not too late. You're too late for let's say, a trade that expires within a month. But if you think that we have a break, that things are changing, we're heading into a bear market, then the opportunity is still juicy. All what you got to do is look at the IWM weekly chart. But this time around, you're not going to play the daily chart. So you're not going to pick expiration dates in your options that are a week or 2 weeks or even 3 weeks till expiration. You're going to go 4 weeks and beyond, because you're playing the weekly chart. You have to go at least 2 months till the expiration date. In this case, you bet, of course, on the 200 days moving average. You can bet a little below, but the bottom line is we have a topping in the shoulder, and we'll probably in a few weeks, we'll head to further declines. Between that, of course, in the daily, we could see fluctuations or rebounds, but if this momentum continues, then we're probably going to hit 200 and even below. Folks, you got to keep in mind, for options trading, the opportunities in trading puts, they happen fast, quick, and they produce the most gains, and that's why we love them. But the key word is fast and quick. You can't overthink it. You can't doubt yourself. And you also have to book profits with discipline. Now, if you're trading calls in an uptrend in the market, you can have your time. You can play with, okay, if there's a pullback, we're going to rebound later. I can wait in the trade and get maximum gains and all of that. But when you're trading puts, you're going to have different mentality. What do we see in the XHB home builders? We're now challenging what could be the neckline at this point, because we have it right here. I would say we've even broken the neckline and topping in the shoulder. So right now, depending on how bad the flush is going to be in the market and the pop in the VIX. But I would say, once again, if you're trading the daily chart for the XHB, for example, you might think, okay, it's oversold, missed the opportunity, but aim for the weekly chart. Aim for a longer dated trade. And for all you know, the XHB could head down all the way to the 200 weeks moving average in this case. That could be a steep decline. If we just drop from here all the way to the 200 weeks, that's about a 16% drop. I'm not going to say it's going to happen right away within a couple of weeks, but if you give it time, of course, the 200 is going to be a little higher, but you'll be below 90. And you're still going to score a massive gain from a decline in the home builders. The question, of course, is where is safety? Where do we find safety? In the stagflation portfolio, when bond yields are going down, you want to go with the XLP staples and the individual names. You can see the volume here is still increasing. So when we talk about the selling volume in the Qs not subsiding yet, indicating that we have more declines to come, at least one more big move, we look at the volume of buying in the XLP, and it has been increasing. This is an accumulation. This is a change in strategy by the asset managers. And it's not done for a month or for a week or for a quarter. They're changing their strategies and portfolio positioning, and the volume is evident to that. And I've been saying this for a while now. The asset managers are beginning to diversify their clients' exposure, and they've been adding to the staples. So right now, I think that the staples are getting a little overbought, but they still got one more move to the upside before they get ridiculous in terms of the overbought conditions. And at that point, you're probably going to see the indices and the Qs being really, really oversold. And then we're going to have a reversal play where we see risk on being in favor again, a risk off pulling back, as we've seen in this pullback right here last Wednesday. Looking at the KRE regional banks, this is among the risk on, but it's been holding a lot better right now because of the alleviation of interest rates going higher. At the same time, it's still holding a bear flag pattern underneath the 50 days moving average, and it could head further down. But I would still suggest that the IWM and the XHP are better shorts than the KRE, but some folks, of course, might see a catch-up trade in the KRE and folks exiting their positioning in regional banks, and that could give you a trade. I'm not against it here. Now, looking at the big banks like JP Morgan, those are more susceptible to coming back down than the regionals because if interest rates are heading down, then it takes away from their advantage, the advantage of interest rate income or interest income, which the growth in interest income in the banks and in the Goldman Sachs of the world, by the way, has been exceeding the non-interest income growth. So they've been reliant on their growth on interest, and now we have lower interest rates, at least recently. And it looks to me that JP Morgan retested the 50 days moving average. It's forming sort of a B leg and an inverse ABC leg pattern. And the next stop is, if we close below the 50 days, is we have a C leg formation. And it could be a steep one, it could be an ugly one. So keep an eye on the 50 on JP Morgan. You lose the 50, you're shorting with both hands. And you can see the pattern already playing out here in Goldman Sachs. Bearish engulfing candle, losing the 50, forming perhaps the bear flag. Might be revisiting all the way to the lows right here to close the gap. And the gap would be, the highs of the gap would be 573.50 or 59, excuse me. The close, which I like to go to the close, 571.53. In any case, it's a steep decline. I think all of the financials are still not done going down. There is one big move to the downside of financials, so keep an eye on them. Now, the third indicator is the dollar. And the dollar right now flirting with the 100 days moving average worth of support. It's down big today. It's part of the recession fears that perhaps the Fed will have to ease or cut interest rates, and that's why we see the dollar heading down. So it's still in alignment with, let's say, the 80% of a recession fear episode. What am I talking about? In the 80% move in the recession fear, we see equities down, we see gold initially rallying, we see equities heading down, we see bonds beginning to catch some steam, but we see the dollar down in expectations of easing. In the last 20% of the move in a recession fear, the climactic move where the VIX explodes, what happens is folks rush to the safety of bonds in the dollar. So in the last 20% of the move, you see gold heading down, you see big flush down in the indices, you see big pop in the VIX, and you see a rebound in the dollar. So I'm not dismissing a rebound here in the dollar because you can see momentum is trying to change from negative to positive. In all, maybe we're forming sort of a higher low in what could be all in all an inverse head and shoulder pattern, and higher we go. So I think that move is coming. And it's, if you see it, you see the VIX moving higher, then you know what's going on. It's the last 20% move of a recession fear episode. What do we see when we look at gold futures? Rebound today based on the dollar coming back down. But again, I reiterate that in the last 20 move of any recession fear episode, you will see a flush down in gold. I think it could be happening in bear flag, ABC, whichever one you want to call it, doesn't matter to me. So an ABC would play out like this. You got the A, rebound in the B, then the C would take you probably all the way to the 50 days moving average in blue, and then we'll see what happens. Another important indicator you have to look at is copper, because copper is holding on pretty good, I would say. And the reason is the dollar has been heading down. But we have copper tariffs coming out soon, number one. Number two, in the last 20% move of a recession fear episode, when the dollar spikes, you see a flush in copper. So when you see copper flushing, maybe taking the range of the lows right here, beginning to head down, then you know what's going on. Dollar is heading higher, copper heading down in the flush, VIX moving higher. Okay, we're in the last 10 to 20% move in a recession fear episode. And crude oil, by the way, is a solid indicator. It's below the 200, so ugly for crude. Why? Because it's confirmation of recession fears. If crude is heading down, it's confirmation of recession fears. But sometimes in the last 10 to 20% move in a recession fear episode, sure, you see the dollar heading higher, you see bonds heading higher, you see the market flushing down, the VIX exploding, copper flushing down. But sometimes, because crude traders are usually ahead of the game, they anticipate things ahead of time. They have to by nature. Sometimes you see, while all of that happening, you see crude oil moving up. And if that is the case, then that's also a leading indicator for you that we're getting to the last bit of piece of the recession fear episode we have a rebound in the market coming. Keep that in mind. What do we do with the souffle Tesla? Daily chart, it's at the 200 right now, so you know if we lose the 200, if we're just going to yo-yo back and forth here and not really cross above 320 or 25, as I said in last night's video, what's going to happen here is just fixing the oversold conditions in the hourly and the daily. You're going to pierce below the 200 again. If you do, we're going to go down and close this gap all together from the month of October, so we're going to shave the entirety of the post-election rally and then some. And of course, lastly, what do we do with Tulip's Bitcoin? Because this one was heading higher, but I cautioned that be careful, it might reverse, and it did. So this is your sentiment indicator. It is now holding on dear life over the 200 days moving average, because if it loses the 200, we got a flush down coming. And again, if there is that last 10 to 20% move of a recession fear episode, what's going to happen is the VIX is going to pay attention now. Take your notes. The VIX is going to spike. The dollar is going to spike. And because of the spike of the dollar, you will see a massive flush down in Bitcoin. And that's, of course, going to happen after the loss of the 200 days moving average. But it is a sentiment indicator. When we see a reversal like this overnight and in today's session, what is that saying? It is saying that whatever pumps that are happening and maybe luring the algorithms or some buyers to step in, the buying volume and the buying power is not strong enough as we've seen post-elections, meaning we have buyers now hesitating. And who's showing up right away? The whales who've been holding. They're selling at better pricing. And that's a behavior that is really, really dangerous. That is leading a lot of folks to assume, okay, the buyers failed, the sellers succeeded. That means that we have more selling to come, and everybody's going to stampede to the exit door at the same time. So let me get the hell out right now. Big move is about to come across the market, as you've seen in this coverage so far. VIX, dollar, indices, Bitcoin, gold, everything. Pick your pick and trade accordingly. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? Not a lot. March 4th, we have a bunch of Fed zombies from New York, Williams. That's going to be important. And then we have Richmond, Barkin. But nothing really from the macro data. It's going to be mostly digesting the tariff news. On the earnings calendar, we have some interesting names from CrowdStrike, cybersecurity, AutoZone, the recession-proof, and then Target, Pulse on the Consumer, along with Ross and Best Buy. But with that, folks, interesting conversation tonight. More will come your way tomorrow. Hope you enjoyed the show, but this is all I got for you for now. Thank you for listening. Thank you for watching. Appreciate and love all of you. We'll be back again at it tomorrow. Good night.
Invigorating.